Friends, thank you for being here today. We stand at a precipice of financial history, witnessing a sequence of events that will likely be studied by economists for decades to come. What if I told you that the massive price crash you witnessed leading into the weekend was not a sign of market weakness, but a desperate, engineered illusion designed to separate you from your wealth? And could it be that the very mechanism designed to suppress the price of silver for the last 40 years has finally, irrevocably snapped? The narrative of the precious metals market is often obscured by technical jargon and rapid-fire price movements, but if we strip away the noise, a clear and undeniable picture emerges. We are no longer dealing with speculation. We are dealing with a mathematical inevitability. The short squeeze has officially begun. It is not a prediction for next year or a hope for the distant future. It is happening right now, confirmed by a convergence of failed regulatory interventions, a breakdown in the physical supply chain, and a panic among the bullion banks that has never been seen in the modern era. In this comprehensive analysis, we will dissect the anatomy of the failed crash, the collapse of the London float, the global run on physical metal, and the technical gamma squeeze that threatens to send prices into a vertical ascent. We are going to look at the crime scene, not to find the culprit, but to understand why their weapon jammed for the first time in history. Let's begin by examining the clear market signal revealed by the anatomy of this failed crash. To understand the magnitude of the current rally, one must first understand the violence of the trap that preceded it. The events leading into the weekend were a textbook example of a bear trap. In financial markets, nothing moves in a straight line, and bull markets are notorious for their ability to buck off riders before the real move begins. The banks, fully aware of the technical landscape, executed a precision strike. They knew that thousands of retail traders and speculators had set automatic stop-loss orders just below key psychological levels, specifically the $60 and $62 marks. Under the cover of darkness, they flooded the order books with paper shorts. They utilized the oldest trick in the book, painting the tape red. For 48 hours, the objective was psychological warfare. They wanted you to believe the silver bull run was over. They wanted to manufacture a crash that looked so convincing that even the most ardent believers would question their thesis. They used a catalyst, a margin hike, to push the price down, just enough to trigger those stop-loss orders. Snap, the stops fired. The resulting cascade of automatic selling created a terrifying red candle on the charts, convincing the bears that the trend was broken. Short sellers piled in, betting the house that silver was returning to $50. But then the trap snapped shut. When the sun rose over London, the smoke cleared, and the bull was still standing. We witnessed one of the most significant market signals of the last decade. It wasn't a press conference, and it wasn't a Fed announcement. It was the price action itself. The market didn't just recover. It exploded. The massive gap up, erasing the losses of the previous sell-off in a single session, is not normal market behavior. It is a scream. It is the sound of a bear trap snapping shut on the fingers of the biggest banks in the world. This V-shaped recovery is technically significant. Weak markets bounce like a dead cat. They fall, bounce slightly, and continue to fall. Strong markets bounce like a tennis ball, but silver? Silver bounced like a Super Bowl. This specific pattern signals that the low is in. The violence of the rally tells us that the selling pressure was artificial, but the buying pressure is organic and overwhelming. This brings us to the critical shift from weak to strong hands. Why did the trap fail? It failed because the composition of the market has fundamentally changed. In 2011, the silver market was dominated by weak-hand speculators using 20x leverage who could not afford a margin call. When the banks shook the tree, these speculators fell out. Today, the market is dominated by strong hands, sovereign nations, industrial giants, family offices, and wealthy individuals protecting their purchasing power. When the price dropped, these entities didn't panic. They didn't sell. They bought. If you panicked and sold during the drop, you provided the liquidity the banks needed to exit their shorts. You were the fuel for this rocket. But if you held, you are watching vindication in real time. The buy-the-dip mentality has shifted from retail traders on Reddit to sovereign wealth funds. These buyers are not price-sensitive. They are volume-sensitive. They care more about securing the physical metal than the margin requirement attached to it. The banks fired their silver bullet, and now they are standing there with an empty gun, staring at a charging rhino. As the market rallied, we witnessed a desperate regulatory counterattack and its subsequent failure. Historically, when the powers that be want to crush a precious metals rally, they have a nuclear option, raising margin requirements. This is the amount of cash a trader must put up to hold a futures contract. By raising the cost of doing business, exchanges can force leveraged speculators to liquidate their positions, causing a cascade of selling. In 2011, this weapon worked perfectly. Margins were raised, and silver collapsed 30% in days, scaring investors away for a decade. This week, we saw a coordinated attempt to deploy this weapon again, and the result was shocking. First, we saw a direct intervention from the COMEX. Breaking news confirmed that the COMEX officially raised margin requirements on silver futures contracts by 10%, effective immediately. The initial margin jumped from $20,000 to $22,000 per contract. In a normal market, or a market driven purely by speculation, this announcement alone would send prices tumbling. We saw this in February 2021, when an 18% margin hike caused an immediate $2 drop in price. However, this time, the market's reaction was unprecedented. The price dipped briefly and then absorbed the blow entirely. Why? Because the entities driving this rally are not operating on thin margins. They have deep pockets. When the exchange said, "You need to put up more cash," these buyers didn't sell. They simply wired the cash. This is a disastrous signal for the manipulators. It means their pain threshold calculation is wrong. They thought a margin hike would break the back of the bull. Instead, it just annoyed it. But the failure of regulation was even more pronounced in the East, resulting in a Shanghai backfire. The Shanghai Futures Exchange, attempting to curb volatility during Asian trading hours, hiked silver margins by a staggering 26%. Market veterans, including respected analysts like David Morgan, issued warnings. Be advised. Increasing margin requirements will affect the price-setting mechanism. The expectation was a brutal sell-off at the Asian Open. But the opposite happened. The Shanghai margin hike backfired spectacularly. Instead of cooling the market, silver rallied nearly 2% during Shanghai trading hours immediately following the hike. As billionaire investor David Bateman noted, if these margin hikes don't meaningfully suppress the silver price, we'll know the paper market is in its death throes. That is exactly what we are witnessing. When a market ignores bad news, regulatory attacks, and margin hikes, it is a sign of extreme underlying strength. It confirms that the paper market's ability to dictate the price of the physical metal is ending. The regulatory tools are broken. The paper price tried to lie to us, but the physical market just told the truth. This brings me to a question I have for all of you watching. What do you think about the exchanges changing the rules and raising margin requirements right in the middle of a rally? Do you see this as a legitimate market tool? Or is it a desperate attempt to manipulate the price lower? I really want to hear your perspective on this, so please let me know your thoughts in the comments section below. With the regulatory attempts failing, we must turn our attention to the London pivot and the collapse of the float. The bear trap was just the setup. The fuel for this fire is coming from London. For 40 years, the London Bullion Market Association, LBMA, has been the suppression capital of the precious metals world. It is where the fix is set. Historically, London acted as the seller of last resort. Whenever New York or Asia panic bought, London would calmly flood the market with supply to cool prices down. But something profound changed this week. London switched sides. Instead of selling into the rally, the bullion banks in the UK began panic buying. This is a change of character so severe it is akin to watching a firefighter pour gasoline on a blaze. Banks do not have ideologies, they have liabilities. They switched sides because of one terrifying metric that the public rarely sees: the float. To understand the panic, we must clarify the crucial difference between the iceberg and the float. Bearish analysts often point to LBMA vault data and say, "Look, there are still 800 million ounces in the London vaults. There is no shortage. Technically, the number is correct. Functionally, it is irrelevant. That 800 million ounces is an iceberg. The vast majority of that metal, estimated at 85% to 90%, is spoken for. It is owned by ETFs. It is owned by sovereign wealth funds. It is owned by family offices that bought it a decade ago and threw away the key. That metal is strategic inventory. It is not for sale at $30, and it won't be for sale at $60. The only metal that matters for price discovery is the float. This is the unallocated metal sitting in the dealer pot, the metal available for immediate delivery, leasing to refineries, or settling futures contracts. Over the last 3 years, while the West was distracted by tech stocks, India and China have been aggressively draining the float. They didn't buy the ETF metal. They bought the dealer inventory. Today the iceberg remains, but the tip the float has melted. It is effectively zero. This creates a liquidity crisis. If a major industrial user like Samsung needs 1 million ounces for production, they cannot buy the ETF metal. They must buy the float. But the float is empty. This shortage has led to a complete breakdown of the leasing machine. This machine is the dark heart of the silver trade. Bullion banks make money by leasing silver to industrial users. The user takes the silver, consumes it, turning it into solar panels or electronics, and promises to return it later plus interest. This system creates virtual supply, as the same ounce can be leased and released, creating the illusion of liquidity. But now the music has stopped. Industrial users are calling the banks to say they cannot return the metal because there is none available to buy on the open market. Lease rates are spiking, which is the market screaming shortage. The banks have a hole in their balance sheets. They show a silver asset on the books, but the vault is empty. To avoid regulatory insolvency, They must go into the spot market and buy physical bars to replace the ones that were consumed. This is the London pivot. The banks are not speculating. They are short covering on a physical level. They are price-insensitive buyers desperate to balance their books before the regulators notice. Adding to the fire is a silent run on the bullion banks, driven by the distinction between allocated and unallocated accounts. Many wealthy investors hold silver in unallocated accounts, which are essentially claims on a pool of metal rather than specific bars. It is a fractional reserve system. Banks might hold 100 ounces of real silver for every 500 ounces of paper claims they sell. The volatility and the Samsung battery news have spooked the big money. Family offices are issuing legal notices demanding to convert their holdings from unallocated to allocated. They want their specific bars, with serial numbers, moved to private vaults. When a client makes this demand, the bank must take 1,000 ounces out of the general pool and tag it. That silver is removed from the float. If the bank was running a fractional system, this demand for allocation renders them insolvent unless they rush to the market to buy the missing metal. This is the panic we are seeing. It isn't a line of people at a coin shop. It is billionaires draining the liquidity of the banking system. While the banks struggle in London, we are seeing a global physical disconnect driven by insatiable demand. While the banks struggle in London, the physical market globally has entered a state of frenzy. We are witnessing a complete disconnect between the paper price and the physical reality. This has resulted in a global frenzy for physical metal. Reports from Singapore depict a scene reminiscent of a Black Friday sale, but for bullion. At major dealers like Bullion Star, lines of people wrapped around the building in the pouring rain. These are not speculators. These are individuals choosing to stand in bad weather for physical metal in hand rather than buying digital promises from home. Weather does not deter conviction. In China, the situation is even more acute. Video footage and reports from mainland distributors confirm that massive stockpiles inventory that should last weeks are being wiped out in a single day. Distributors are reporting that all our silver today has been completely sold out, every last bit. Customers are eagerly waiting for shipments to arrive just so they can pick them up immediately. This is a global phenomenon. The smart money in Asia and the street money globally are moving in lockstep, recognizing that the paper currency in their pockets is losing value while the metal is retaining it. Contrast this physical scarcity with the absurdity of the paper billion. On the day of the attempted crash, the paper market traded over 1 billion paper ounces in a single session. To put that in perspective, the entire global mining industry produces approximately 800 million ounces in a full year. The banks traded 25% more silver than exists in annual production in just a few hours. This absurdity highlights the manipulation. They weren't trading real metal. They were trading digital contracts to suppress the price. But the fact that the price recovered so quickly, despite this billion-ounce onslaught, proves that the physical market has finally overpowered the paper market. As billionaire David Bateman suggested, the inability of a billion-ounce dump to sustain a lower price is the ultimate proof that the manipulation is failing. Perhaps the most damning evidence of the shortage is the state of backwardation. Normally, the futures price of silver is higher than the spot price to account for storage and interest costs. When the spot price rises above the futures price backwardation, it signals massive stress. It means the market values a bird in the hand today much higher than a bird in the bush tomorrow. We have seen silver flirt with and enter backwardation, a condition that rarely persists unless there is a critical failure in supply delivery. With the fundamentals screaming shortage, we must look at the technical roadmap and the looming $65 gamma wall. With the fundamentals screaming shortage, we must look at the technical roadmap. Price does not go up in a straight line. It moves from battle to battle. The current battleground is the $65 level. This price level is effectively the kill zone for the shorts. $65 is not just a resistance line on a chart. It is the kill zone for the short sellers. In the options market, there is a massive concentration of call options at the $65 strike price. Millions of ounces are betting on a break above this level. For the banks who sold these options, $65 is the line in the sand. If the price stays below it, the options expire worthless and the banks keep the premiums. If it crosses $65, the banks are on the hook to deliver millions of ounces they do not have. This setup creates the potential for a powerful gamma squeeze mechanism. This mechanism is similar to what drove the stock prices of GameStop and Tesla to astronomical heights. As the price approaches $65, market makers, the banks, are forced by their risk management algorithms to delta hedge. This means they must buy silver futures to cover their exposure. However, their buying pushes the price higher, which increases their risk, forcing them to buy more futures. This creates a self-reinforcing feedback loop. If silver breaks $65 with volume, the market makers flip from being neutral defenders to being forced buyers. They will have to chase the price to $66, $67, and $68 just to cover their exposure. This creates a vacuum effect above $65 where resistance disappears because the defenders have become the buyers. While the metal rallies, there is a fascinating disconnect, creating a mining stock arbitrage. While the metal rallies, there is a fascinating disconnect in the mining stocks. On the day of the crash, miners like First Majestic and Pan American Silver were hammered, dropping 4 to 5%. Equity traders, governed by fear, treated the drop as the end of the world. But with silver recovering to $63, these companies are effectively printing cash. This lag creates a massive arbitrage opportunity. The rubber band between the metal price and the stock price is stretched to the breaking point. Historically, miners lagged the metal at turning points because Wall Street waits for confirmation. But once that confirmation comes, the catch-up trade is explosive. If silver holds these gains, the math dictates that mining stocks must gap up significantly to reflect their earnings potential. As we look toward the end of the year, we must consider the future outlook, valuations, and market psychology. As we look toward the end of the year, several forces are aligning to push silver prices even higher, regardless of the day-to-day volatility. We are entering a period characterized by window dressing and institutional FOMO. We are entering the window dressing season. This is the time of year when hedge funds and mutual funds prepare their annual reports for clients. No fund manager wants to explain why they missed the best performing asset of the year. If silver is up significantly and a fund holds zero, the manager looks incompetent. To avoid this, funds will buy the winners in late December just to show them on the balance sheet at year-end. They are price insensitive. They just need the position to save face. This creates an artificial powerful tailwind. Funds that ignored silver at $30 and $40 are now forced to buy at $63. This institutional FOMO, fear of missing out, is what drives prices parabolic. Markets are cruel mechanisms, often moving in the direction of the max pain trade. Markets are cruel mechanisms designed to transfer wealth from the many to the few. They typically move in the direction of the max pain trade, the outcome that causes the most pain to the most people. Consider the scenarios. If silver crashes back to $50, who does this hurt? Only the silver bugs who are used to pain and will simply buy more. This scenario generates no liquidity for the banks. On the other hand, if silver rips to $75 or $100, the damage is widespread. It destroys the banks who are short hundreds of millions of ounces, panics the industries that need silver for production, and humiliates the hedge funds that are underweight commodities. Because scenario B causes maximum pain to the establishment, blowing up bank balance sheets and forcing the smart money to chase highs. The laws of market sadism dictate that a massive rally is the most likely outcome. Where is this going? The valuations and targets are staggering when viewed through historical lenses. Where is this going? The valuations and targets are staggering when viewed through historical lenses. Silver briefly entered the top 5 assets by market cap, surpassing Bitcoin, which signals that the world is waking up to the value of tangible assets over digital ones. We must also look at the gold-to-silver ratio. Currently, it takes about 70 ounces of silver to buy 1 ounce of gold. If we were to return to the 2011 ratio of approximately 36:1, silver would be priced around $120 per ounce. If we return to the 1980 ratio of 18:1, silver would be priced around $235 per ounce. Look closely at the purchasing power. In 2005, $500 bought you a massive stack of 72 ounces of silver. Today, $500 buys you a handful of just 8.5 ounces. The currency is collapsing against the metal. Analysts are increasingly comfortable throwing out the $100 price target for next year. But as the float vanishes and the squeeze intensifies, even that number may prove conservative. Friends, before we dive into the final psychological warfare tactics being used against you, I have a small request. If you are finding value in this analysis and you want to support our mission to uncover the truth about these markets, please hit that like button and subscribe to the channel. It really helps get this information out to more people who need to hear it. However, beyond the charts and the valuations, there is a psychological weapon being deployed against you that is just as potent as the margin hikes: the regret machine. Markets run on 2 engines, greed and fear. But there is a third, more powerful engine: regret. The V-shaped recovery we just witnessed, where the price crashes and immediately recovers to new highs, is a finely tuned regret machine. Think about the trader who sold on Friday. He was scared. He saw the red numbers and thought he was being smart. He thought, "I'll sell now and buy back lower at $55. He went to bed feeling safe. Then he woke up on Monday, and silver was higher than where he sold it. He didn't save money. He lost his position. Now he faces a brutal choice: admit he was wrong and buy back in at a higher price, or wait and pray for another crash. Most people wait. They refuse to admit defeat. They watch the price climb to $65, $68, $70. The regret festers and turns into FOMO. Eventually, they panic and buy back in at the top. This is how bubbles are formed. The recent volatility was a cleansing event designed to wash out the weak believers early, leaving the train lighter so it can travel faster. If you held through the shakeout, you aligned yourself with the pain trade. You are the one inflicting the pain, not receiving it. But this psychological game is colliding with a hard physical reality that the bankers can no longer ignore: the phenomenon of industrial singularity. For decades, silver was traded like a currency, moved from vault to vault. But today, we are witnessing an industrial singularity where silver is being consumed, not just stored. The recent news regarding Samsung's battery technology is not just a headline about a gadget. It is a signal of a fundamental shift in the nature of the metal. Samsung and other tech giants are developing solid-state batteries and advanced electronics that require massive amounts of silver. Here is the critical difference between gold and silver. When gold is bought, it sits in a vault. It is recoverable. When silver is bought for industry, it is consumed. It goes into a missile, a solar panel, or a battery. It ends up in a landfill or dispersed in microscopic amounts that are too expensive to recycle. It is gone forever. You cannot print a battery. You cannot print a solar panel. You have to dig the metal out of the ground. This creates a terrifying reality for the bullion banks. Their entire fractional reserve model relies on the ability to lease metal out and get it back. But the industrial users are now calling the banks and saying, "We can't return the metal. We consumed it." The metal is on a roof in Germany. It is in a Tesla in California. The banks are realizing that the virtual supply they created through leasing has vanished into the industrial ether. They are short a physical commodity that is being chemically transformed and removed from existence. This is why the shortage is structural, not cyclical. The Samsung battery narrative is the cover story for a much deeper truth. The physical world is reclaiming its value. And the supply cushion that allowed for decades of manipulation has been soldered onto circuit boards and lost to history. In conclusion, we are witnessing the great unwind. Friends, the bear trap has snapped, but it didn't catch us. It caught the banks. The rocket has cleared the tower. We are living through a historic pivot point, a wealth transfer from the financial to the real, from derivatives to factories, from paper to metal. The recent volatility was a cleansing event. It washed out the leverage, reset sentiment, and turned overbought conditions into neutral ones without breaking the trend. The failure of the margin nukes and the panic in London confirmed that the short squeeze is no longer a theory. It is a mechanical reality unfolding before our eyes. The $65 gamma wall is shaking. The physical buyers in China and Singapore are relentless. The industry is desperate, and the banks are trapped. The volatility will get worse. $2 swings will become $5 swings, but you must harden your stomach. The strategy remains simple. Sit tight. The market is doing the work for us. The shortage is doing the work for us. For 40 years, wealth flowed into paper assets. That tide has turned. The Samsung battery, the solar panel, and the bar in the vault are the new reality. You held through the dark. Now watch the dawn. The squeeze is on.